There is this incredibly specific, almost universal experience of just walking through a sprawling, echoing suburban shopping mall.
Oh, yeah, the invisible wall.
Exactly.
Yeah.
You can be completely blindfolded, completely disoriented, but the second you cross a certain threshold, you know exactly where you are.
Right.
You hit that atmospheric wall of Japanese cherry blossom or warm vanilla sugar.
Eucalyptus spearmint is the one that gets me.
Right. And your brain just immediately fires a signal. I mean, it's this purely sensory, highly nostalgic experience for millions of people.
Yeah.
We're walking past a Bath & Body Works.
Yeah, they have essentially weaponized olfactory memory. I mean, scent is the strongest sense tied to memory.
Yeah.
And over the decades, they've leveraged that biological reality into a multi-billion-dollar retail empire. Like, the stores themselves act as these massive ambient billboards.
And it works. It's warm, it's fuzzy, it's emotionally resonant for you as the consumer. But, when you step out of the mall and onto Wall Street, all of that warm and fuzzy emotion gets stripped away instantly.
Completely.
The sensory experience is just replaced by cold, hard, unforgiving mathematics. Like, the nostalgia really doesn't matter if the margins are compressing.
It absolutely does not.
And that collision, right, between this deeply loved consumer brand and the brutal realities of the current retail landscape is exactly what we are pulling apart today.
Welcome to the deep dive.
Yes, welcome. Today we are putting on our Talk Tickers lenses. And for those of you joining us, that means we are ditching the marketing fluff entirely.
No sugarcoating today.
None. We are taking a data-forward, highly opinionated, and actionable look at the Bath & Body Works Q1 2026 earnings call. We're translating all that Wall Street jargon into the actual mechanics of the business.
Right. Pulling out the raw numbers.
Yeah. And giving you the bottom line on what this means if you are holding this stock or, if you're just curious about how modern retail actually functions under the hood.
And I think the context surrounding these numbers is critical before we even start.
Set the stage for us.
So Bath & Body Works is not operating in a steady state environment right now. Management is actually in the dead center of a massive, comprehensive corporate pivot.
Right. They call it their consumer-first formula, right?
Exactly. The consumer-first formula. It's a multi-year renovation designed to return the company to sustainable, consistent growth after some serious post-pandemic turbulence.
Makes sense.
So our goal today is to look at the hard data from this transcript and, determine the structural integrity of that renovation. Are they building on a solid foundation, or is the house caving in?
Right. So let's look at the actual tape. Wall Street always models out a very specific set of expectations for every quarter, and we need to see where Bath & Body Works actually landed against those models. Let's start with the headline numbers.
Okay, so the top line net sales for Q1 2026 came in at $1.4 billion.
Okay.
Which represents a top line decline of 3.2% year over year. On the profitability side, their adjusted earnings per share came in at 32 cents.
Right, the EPS.
Yeah. But looking deeper at the profitability metrics, the adjusted gross profit rate was 42.7%, which represents a decline of 270 basis points.
Okay, wait, let me jump in there to translate that for a second. When Wall Street says 270 basis points, they just mean 2.7%, right?
Yes, exactly. 2.7% of their gross profit margin just evaporated compared to last year.
Got it.
And within that, their adjusted merchandise margin rate declined by 210 basis points.
Okay, so just to recap the reality here, the revenue is shrinking by 3.2%, and the profit margins on the actual items they sell are compressing by roughly 2.5%.
Yeah, it's a squeeze.
But any conventional retail logic, a shrinking top line and a compressing margin should trigger a massive sell-off. The stock should be taking a beating.
You would though.
And yet, if you watch the market reaction, this quarter was largely celebrated by analysts as a quote-unquote beat. Management sounded almost relieved. I mean, how does a company shrink its sales, lose margin, and still get a pat on the back from Wall Street?
Well, it highlights the difference between absolute performance and relative expectations. I mean, the market is a forward-looking stress testing mechanism.
Right.
Sell-side analysts build these really complex models predicting how a company will perform based on foot traffic data, credit card scraping, macro trends. And coming into this quarter, those models predicted a much, much steeper decline.
It's basically like a weather forecast.
How so?
Like if the weatherman predicts a Category 5 hurricane is going to wipe out your town, but you only get a really bad thunderstorm that knocks over a few trees, you consider that a massive win.
Oh, yeah. You're popping champagne because your house is still standing.
Exactly. They were priced for a disaster. Wall Street modeled a steeper sales decline and way lower earnings. So when the CEO, Daniel Heath, delivered 32 cents of adjusted EPS,
which, by the way, he specifically noted was the absolute highest they expected internally for this quarter.
Right, so the market treats it as a victory. They survived the stress test way better than the doomsday models predicted.
But, survival isn't a sustainable investment thesis. I mean, beating lowered expectations might give this stock a temporary bounce today, but as analysts, we have to look at the underlying physics of that margin compression.
Yeah, why did they lose that 2.7%?
Exactly. Why did those margins shrink by 270 basis points? That tells us about the structural health of the business, independent of Wall Street's emotional relief.
Because losing tens of millions of dollars in gross profit on $1.4 billion in sales, that is a tangible leak in the boat.
It's a huge leak.
And the CFO, Eva Barato, broke this down on the call. And she didn't just point to consumer weakness, right? Like people just not buying candles.
No, she didn't. The margin compression was actually largely driven by macroeconomic externalities.
Right.
She cited tariffs, general inflation, and interestingly, a massive headwind from crude oil impacts.
Right.
Yeah, she noted those external macro forces accounted for about 130 basis points of that total merchandise margin decline.
Okay, wait, I want to pull the thread on that crude oil comment. Because on the surface, if you are just a casual observer, hearing the CFO of a company that sells like eucalyptus spearmint body wash blame the price of crude oil for missing margins.
It sounds like a cop-out.
It sounds like a total excuse. It sounds like they are just throwing a geopolitical dart at a board to explain away a bad quarter. How is the price of a barrel of West Texas Intermediate actually moving the needle for a mall-based soap retailer?
Well, to understand that, you really have to look past the branding and look at the physical and molecular composition of what Bath & Body Works actually manufactures and ships.
Okay.
Think about the entire life cycle of one of their hero products. Let's take a bottle of their famous body wash. What is that physical vessel actually made of?
Well, it's plastic. Polyethylene terephthalate, mostly. PT plastic.
Exactly, PE plastic. And plastic is a petrochemical product derived directly from crude oil. So when global crude oil prices spike, the cost of the raw resin required to manufacture every single plastic pump, every lotion tube, every sanitizer bottle on their shelves, it all goes up.
Oh, wow.
But the exposure doesn't stop at the packaging. Look at the actual ingredients. A massive, massive portion of their revenue comes from home fragrance. Specifically candles.
Right.
And while they do incorporate natural waxes, the global candle industry still relies heavily on paraffin wax to maintain scent throw and burn consistency.
And paraffin is quite literally a byproduct of the petroleum refining process.
Yeah.
So the vessel holding the product is tied to oil, and the consumable product inside the vessel is tied to oil. That's wild.
And it goes even further into the logistics. Think about it. Bath & Body Works operates roughly 2,500 physical stores across the globe.
That's a massive footprint.
Plus a massive direct-to-consumer digital shipping operation. So the physics of their business model involve moving heavy liquid-filled bottles and heavy glass jars of wax from manufacturing hubs, many of which are in Asia, to distribution centers in North America.
All right.
And then dispatching them to thousands of individual retail doors. Moving heavy liquids and glass requires an astronomical amount of kinetic energy.
Which means burning bunker fuel in trans-Pacific cargo ships and burning diesel fuel in thousands of long-haul trucks across the highway system.
Which means when crude oil prices remain elevated and management explicitly stated their models assume elevated energy costs for the rest of a year, it acts as this compounding hidden tax on every single node of the supply chain.
From the raw resin of the plastic bottle in the factory to the paraffin wax to the diesel in the truck idling behind them all.
Exactly. It is a profound structural margin pressure that management has almost zero control over. They can't change the price of oil. They can only try to offset it with internal cost cutting through their, what they call their Fuel for Growth initiative.
Okay, so half of that margin compression is just the brutal reality of moving physical petrochemical adjacent goods in an inflationary environment.
Yeah.
But, that only explains the margins. It doesn't explain why top-line revenue actually dropped 3.2% in the first place. For that, we have to move off the spreadsheet and look at the actual merchandising strategy.
We have to look at the tables in the stores.
Exactly. We have to walk the physical and digital aisles. because the transcript reveals this fierce internal tug of war happening within their product categories right now.
It does. We need to dissect the failures and the successes, starting with the absolute biggest drag on the quarter. CFO Eva Barato stated flatly that the body care category declined in the mid-teens.
A mid-teens drop is not just a minor fluctuation.
Oh, it's massive.
If you are talking about 13, 14, 15% down in a category literally called body care for a company named Bath & Body Works, that is a structural failure in your core engine.
It is their foundational category, and a drop of that magnitude requires a real forensic look. But, CEO Daniel Heaf was surprisingly transparent about what went wrong here.
He didn't sugarcoat it.
No, he didn't hide behind the macro environment for this metric. He pointed to two specific self-inflicted merchandising errors.
Okay, let's break those down. What was the first one?
The first was a licensing play, specifically the Disney Princesses 2 collaboration.
Okay, see, on paper, pairing a beloved fragrance brand with Disney intellectual property sounds like an infallible strategy. It should be a license to print money.
You would think so.
But Heath admitted that they mismanaged the product mix. They leaned way too heavily into accessories rather than their core consumable products.
Right. And the psychology of retail collaborations is really fascinating here. Usually a brand brings in a major IP like Disney to drive top-of-funnel excitement, right?
Get people to the door.
Exactly. Foot traffic, novelty. The goal is to get a customer into the store for the hype and then have them actually buy the high-margin consumable core items.
The lotions and the body washes that get used up and require you to repurchase next month.
Yes. But with Disney Princesses 2, Bath & Body Works over-indexed on hard goods. Cosmetic bags, themed accessories, hard plastic novelties.
Which completely cannibalizes the core purchase.
Yep.
Like, think about it. If you walk into the store with a mental budget of $40 and you immediately spend $25 on a cute Disney princess cosmetic bag, you're very likely going to skip the $15 body lotion.
Because your budget is tapped.
Right. The novelty accessory effectively blocked the purchase of the consumable product.
And those accessories have a completely different margin profile and purchase velocity. A consumer buys a cosmetic bag once.
They don't come back next month for a bag refill.
Exactly. So by flooding the tables with accessories, they depress their core volume in body care, hurting both immediate sales and the recurring revenue cycle.
But the second culprit Heath mentioned was arguably a much more alarming misstep, and it centered around an internal brand called Everyday Luxuries. This wasn't a licensing issue with Disney. This is a massive inventory miscalculation.
It was. Heath stated, and I'll quote this directly, "We pulled back too substantially on that assortment." They essentially choked off the supply of a product line that customers actually wanted to buy.
Probably in an attempt to rationalize their SKUs, right?
Almost certainly.
It's the classic pendulum swing of SKU rationalization. You have a massive catalog of products. Management decides things are too complex and expensive to maintain in the supply chain, so they start trimming the bonsai tree.
Trimming the fat.
But they trimmed way too far and accidentally cut off one of the main branches.
Right.
It's like a restaurant taking their most popular burger off the menu to save on food costs, only to realize nobody wants to eat there anymore. They pulled back the Everyday Luxuries line to save costs, and the consumer response was to just stop buying body care altogether.
But as analysts, we have to look at how management responds to an error, not just the error itself.
Fair point.
Heath noted that their internal telemetry caught the mistake very quickly. And as of May, right in the middle of Q2, they actually managed to rush 10 top-selling fragrances from that Everyday Luxuries line back into stock across the fleet.
Specifically in the fine fragrance mist and body cream formats.
Exactly.
That speed is actually the silver lining here, because a rigid, bureaucratic retail management team would have blamed the consumer, stayed the course, and just waited for next year's planning cycle to fix the assortment.
Oh, happens all the time.
The fact that they identified the missing demand, sourced the raw materials, spun up the manufacturing lines, and rushed 10 specific SKUs back to 2,500 physical locations in a matter of weeks. That shows serious operational agility.
It does, and Heath noted they're already seeing strong early reads on that returning inventory. It suggests the brand hasn't really decayed. They just literally hid the product the consumer wanted.
Right, the demand is perfectly intact. The execution just faltered.
But, we have to balance the narrative, because while body care was really struggling, other areas of the store were actually outperforming the broader retail environment. Let's look at home fragrance, which is primarily their candle business.
Okay.
That category saw a low single-digit decline overall, but candles themselves performed above the shop average, buoyed by some highly strategic pricing.
And buried in that home fragrance data was a really stunning metric. A specific line called White Barn Neutrals actually grew by 20% in Q1 compared to last year.
20%.
Finding 20% growth in an environment where overall sales are shrinking by 3.2% is incredible. So what is the architecture behind that specific line that is making it defy gravity?
It's a perfect alignment with a macro shift in consumer aesthetic preferences. I mean, historically, Bath & Body Works has been defined by very loud, neon-colored, heavily patterned packaging.
Very 2010s. It screams mall culture.
Yes. But the White Barn sub-brand has always been their slightly more elevated, sophisticated tier. And by heavily leaning into the neutrals concept like minimalist typography, muted earth tones, sophisticated scent profiles, they are capturing a demographic that is aging out of the neon aesthetic.
It's the physical manifestation of the quote-unquote sad beige aesthetic that has totally taken over home decor on social media.
Exactly.
Millennials and Gen Z consumers want their homes to look like curated minimalist sanctuaries or high-end spas. A hot pink glittery candle with giant cursive font just massively disrupts that aesthetic. Bath & Body Works recognized that the vessel matters just as much as the wax inside it.
They did, and they backed it up with targeted marketing too. They specifically partnered with lifestyle creators and influencers who focus on home elevation, utilizing live ad reads on podcasts to target a younger, design-conscious consumer.
A consumer who might have previously dismissed the brand as just being too juvenile.
Right, and it worked brilliantly.
Now, the other bright spot was the soaps and sanitizers category, which managed to grow low single digits. But within that category, there was a specific product launch that gives us a real window into their pricing power.
Yeah, the hand soaps.
They launched a brand new line of moisturizing and revitalizing hand soaps, and the underlying metrics on those specific items were phenomenal.
Both the SKU productivity and the average unit retail, the AUR, jumped by double digits for these new soap formulas.
Okay, let's focus on AUR for a second, because in a deflationary retail environment, average unit retail is the holy grail.
It really is.
For those newer to the mechanics, AUR is simply the average price a customer actually pays at the register for a single item. If a store used to sell a bottle of soap for $3 on a heavy promotion, and now they consistently sell it for $4, their AUR went up.
Simple math.
But driving a double-digit increase in AUR on a total commodity product like hand soap is incredibly difficult. Why are consumers suddenly willing to pay a premium?
Well, it comes back to Daniel Heaf's philosophy on the definition of value. He articulated this beautifully on the call. He said, value is not simply price. It is the quality of the product, the clarity of the benefit, and the strength of the experience relative to the price the consumer pays.
That runs so counter to the panic response of most struggling retailers.
How so?
Well, when foot traffic drops, the instinct is to just slash prices.
Yeah.
You put out the giant red buy 3, get 3 free signs. You aggressively discount and you just race to the bottom to drive volume. Heaf is arguing the exact opposite.
He's arguing that if you upgrade the physical experience, which they did by engineering better pumps and designing more elevated bathroom-worthy vessels for these new soaps, and if you clarify the specific functional benefit on the label, making it explicitly clear this isn't just soap, it's a moisturizing and revitalizing treatment, the consumer will willingly cross a higher price threshold.
They're no longer buying a utility item just to clean dirt off their hands. They're buying a mini luxury experience to place on their guest bathroom counter.
Exactly. When you elevate the perceived quality, the price resistance just melts away.
Better product, clearly communicated, yields higher margins. It sounds so fundamental, but actually executing that transition across millions of units without alienating your core bargain hunting customer is a massive tightrope walk.
It really is.
Which brings us to what I consider the most fascinating and potentially controversial strategic pivot discussed on this call. Their omni-channel strategy, and specifically their new partnership with Amazon.
Oh, this is the big one. To set the baseline here, their direct channel net sales, which is essentially just bathandbodyworks.com, came in at $246 million.
Okay.
That's down 1.5%. And to try and stimulate that direct demand, management actually lowered their free shipping threshold down to $50.
Which pinches margins a bit.
It does. Now, on the other side of the ledger, their international retail sales, driven heavily by franchise partners, grew low double digits, which is a really strong result given the geopolitical friction in the Middle East that management noted as a pressure point.
But the real gravitational pull in their digital strategy is Amazon. Bath & Body Works officially launched a curated storefront on Amazon in February.
Yep.
And right now, they have roughly 94 unique SKUs available on the platform. To give some context, 94 SKUs represents only about 7% of their total active in-store assortment.
So it's a tiny, highly restricted slice of their catalog.
Exactly. But as an analyst looking at retail mechanics, I have to challenge this move. Let's interrogate the strategy here. What is the bear case for a massive brand like this joining Amazon?
Well, the bear case is the loss of the walled garden. Historically, massive heritage retailers guard their direct-to-consumer ecosystem with their lives.
Right, like Nike.
Exactly. Brands like Nike famously pulled their products off Amazon because they hated losing control of the brand presentation, the pricing mechanics, and most importantly, the customer data.
Because if you own the customer on your own proprietary website, you get their email address, you track their browsing history, and crucially, you keep 100% of the gross margin.
You don't share it.
So by putting your 94 best-selling hero products on Amazon, aren't they just cannibalizing their own organic web traffic? Aren't they taking a customer who is perfectly willing to type your URL into their browser and instead handing Jeff Bezos a massive cut of your margin and fulfillment fees?
It's the classic innovator's dilemma in modern e-commerce. Do you protect your walled garden or do you fish where the biggest school of fish lives?
Right.
But Heath's data from the transcript provides a really compelling counter-narrative to that cannibalization fear. He explicitly stated that Amazon is acting as a high-efficiency customer acquisition engine, not just a transaction portal for existing fans.
Okay, but how does the data actually prove that?
Because they are tracking the demographic profile of the shoppers transacting on their Amazon storefront, and they were seeing a highly meaningful skew toward younger and significantly more affluent consumers. These are demographics that, frankly, were not visiting the suburban C-tier malls, and they were definitely not engaging with bathandbodyworks.com. These are Prime members who place an absolute premium on the frictionless, one-click speed of the Amazon logistics network.
So the argument is that the customer acquisition cost the CAC of trying to force that affluent younger Prime member to visit a separate website and go through the friction of creating a new account is actually higher than the fee they pay Amazon to just fulfill the order natively.
Precisely. They aren't cannibalizing existing shoppers. They are accessing a net new, wealthier demographic.
Yeah, it makes sense.
But the data point that truly validates the strategy is the pricing dynamic. Management noted that they are actually achieving a higher average unit retail on Amazon than they are on their own proprietary digital channels.
Wait, really? That is deeply counterintuitive. Amazon is famously a highly price-sensitive comparison shopping environment. How are they getting a higher price per unit on Amazon than on their own site?
It's all because of the promotion culture embedded in their own brand. On bathandbodyworks.com, the entire customer psychology is built around waiting for the massive promotions.
So like the semi-annual sale.
Exactly. The semi-annual sale, the buy three, get three events, the core legacy customer will not transact without a coupon.
Right.
But on Amazon, that younger, affluent, time-starved customer isn't hunting for a promo code. They search for a specific hand soap, they see it for $15, they click buy now because they just want it on their porch by tomorrow afternoon.
Oh, wow.
The margin they surrender to Amazon's platform fees is being heavily offset by the complete lack of promotional discounting.
That is fascinating.
He views it as a highly curated complement to the business.
Yeah.
If you want the full 2,500 item catalog and you want the deep discounts, you still have to enter their walled garden. If you just want convenience, you pay full price on Amazon.
It's a brilliant segmentation of consumer intent. But there was a detail regarding this Amazon integration that management mentioned almost in passing, and it completely blew my mind.
I know exactly what you're going to say.
There is this bizarre, highly technical side effect to this Amazon launch that they just sort of stumbled upon.
You're referring to the metadata optimization.
Yes. Because to sell effectively on the Amazon marketplace, you can't just upload a low-resolution image and a 2-word title.
No, the Amazon algorithm will bury you.
Exactly.
Yeah.
The Amazon A9 algorithm demands intense data enrichment. You have to write exhaustive, highly structured descriptions of the scent notes, the chemical ingredients, the functional benefits, and the dimensional weight of the packaging. You have to feed the algorithm an incredibly dense diet of high-quality metadata.
And the unintended consequence of structuring all that data for Amazon is that they inadvertently optimize their entire catalog for generative AI.
It's wild. Heath noted that by enriching their product data to play the Amazon SEO game, they are suddenly seeing their products being recommended much more accurately and frequently on platforms like ChatGPT and Anthropic's Claude.
That is a staggering realization. By trying to appease Jeff Bezos' search engine, they accidentally future-proofed their digital footprint for the semantic AI shopping era.
We are absolutely going to dive deeper into the philosophical implications of that at the end of the show, because the idea of an algorithm acting as the primary consumer is just wild.
It really is.
But for now, let's look at how management intends to pay for all this. Because redesigning products, integrating with Amazon, and executing a consumer-first formula turnaround, that requires a tremendous amount of capital. So what is management projecting for the rest of the year?
Well, the guidance for the second quarter is going to require investors to have a very strong stomach.
Uh-oh.
Yeah, Q2 net sales are forecasted to be down 5% to 3%, and the EPS is expected to take a significant sequential drop, landing somewhere between 20 cents and 25 cents.
So we are looking at a quarter where the top line shrinks by up to 5%, and the earnings compress to 20 cents a share. That is a brutal forecast.
It is brutal, but this is the crucial pivot point of the entire earnings call. Despite that ugly Q2 forecast, management completely reaffirmed their full year 2026 guidance.
Wait, really?
Yes. They are maintaining the expectation that full year sales will end up down 4.5% to 2.5%, and full year EPS will land between $2.40 and $2.65.
Okay, so if we model that out, the math tells a very specific story about their internal confidence. If Q1 was a mild beat, and Q2 is explicitly forecasted to be a deep valley with sales dropping 5%.
Right.
But the full year targets remain completely unchanged. It means management is modeling a massive hockey stick recovery in the back half of the year.
Exactly. Q2 is the trough. Management is essentially using the summer to take their medicine. They're flushing out the bad inventory, they're absorbing the costs of the strategic turnaround, and they're basically telling Wall Street, just hold your breath for 3 months.
They're cleaning house.
Right. They expect the third and fourth quarters, which encompass the make-or-break holiday shopping season, to finally display the financial yield of this consumer-first formula.
And that yield requires heavy upfront investment. Let's look at the cash flow and capital allocation, because a company's CapEx spend shows you exactly where their strategic priorities actually lie, right? Regardless of what the marketing copy says.
Yep. And despite the top-line pressure, Bath & Body Works remains a highly cash-generative machine. The company expects to produce approximately $600 million in free cash flow in 2026.
That's a lot of cash.
It is. Now, it's important to note that this figure is receiving a one-time boost of $66 million from an interchange fee litigation settlement that was recognized in Q1.
Okay, just to provide context on that for you listening, interchange fees are the swipe fees that Visa, MasterCard, and the banks charge retailers every time a consumer uses a credit card. There has been this massive, years-long class action litigation across the retail sector alleging those fees were artificially inflated. Bath & Body Works is finally getting a $66 million check from that settlement. It's a fantastic injection of liquidity for the balance sheet, but, it is not operational revenue. We have to strip that out when evaluating the core business.
Exactly. It bolsters the war chest, but it doesn't mean they sold more candles. So, out of that roughly $600 million in free cash flow, management is deploying $270 million into capital expenditures.
Okay, if I'm an investor holding this stock, I want to know exactly what concrete assets you are building with my $270 million. Where's the CapEx going?
A massive portion of it is being directed into the physical store fleet, specifically through a strategy of geographic migration.
What does that mean exactly?
In the first quarter alone, they opened 13 new North American stores. But the critical data point is the location of those new doors. They are aggressively prioritizing off-mall locations and expanding their footprint in high-density areas like New York City. And simultaneously, they closed 17 older stores, which were primarily located inside traditional enclosed indoor malls.
We are watching the grand migration of American retail play out in real time here. Management sees the telemetry. They know the traditional enclosed B-tier and C-tier suburban mall is dying a slow death.
It's a ghost town in a lot of places.
Exactly. The organic foot traffic is drying up as the big anchor department stores go bankrupt. The modern consumer demands extreme convenience. They want to pull their SUV right up to an outdoor strip center or an open-air lifestyle center, run in, grab their specific hand soaps, and leave without navigating a massive parking garage and a food court.
Precisely.
Bath & Body Works is actively pruning the dead branches of those enclosed mall stores and planting new roots in these high-velocity off-mall locations.
And for the 2,500 physical doors that remain operational, they are deploying that CapEx toward a massive interior philosophical shift. Beginning in July, they are rolling out sweeping updates across the entire fleet to create what they call a more intuitive in-store navigation experience.
So what does intuitive navigation actually mean in terms of physical retail architecture?
It means the death of the treasure hunt merchandising model.
Oh, wow.
Historically, Bath & Body Works, much like TJ Maxx, relied on cross-merchandising to force discovery. They would place the lotion on one table, the matching candle across the store, and the body mist somewhere else entirely.
Hoping you'll buy stuff along the way.
Exactly. The goal was to force the consumer to wander the entire square footage, hoping they would impulse buy items along the journey. But the modern consumer, whose brain has been completely rewired by the ruthless efficiency of one-click e-commerce, just no longer has the patience for the treasure hunt.
They don't want to wander, they want to execute a mission.
Right. So the redesign involves fundamentally changing the signage, the fixtures, and the layout, so the store is rigorously organized by fragrance, form, and franchise.
Makes sense.
If a customer walks in seeking the 1,000 Wishes scent profile, the lotion, the mist, the scrub, and the candle will all be cohesively merchandised in one vertical block. It reduces friction, respects the customer's time, and accelerates checkout.
So they are fundamentally ripping up and redesigning the traffic flow and consumer psychology of 2,500 stores starting this summer. That massive operational disruption perfectly explains why Q2 earnings are forecasted to be so compressed.
That's a lot of construction.
But speaking of disruption, we have to address the elephant in the room from this earnings call. Right at the tail end of the transcript, management announced a massive piece of corporate intrigue.
Oh, the CFO transition.
Yes.
Eva Barato, the chief financial officer who has been architecting the financial strategy for this entire turnaround, is stepping down. And Tom Javage is stepping in as the interim CFO.
See, as an analyst, whenever a chief financial officer leaves abruptly in the dead center of a massive multi-year capital-intensive turnaround plan, my collective spider sense starts screaming.
Oh, absolutely.
The CFO is the architect of the models. They know where every dollar is buried, and they know the actual math behind the back half projections. Is this departure a giant waving red flag that the internal models are failing? Are those Q3 and Q4 hockey stick projections built on sand, and she is ejecting before the structural collapse?
It is entirely rational to view executive turnover with extreme prejudice, especially in a turnaround scenario. I mean, volatility in the C-suite almost always breeds volatility in the stock price.
Right.
However, we have to contextualize this specific departure based on the mechanical signaling in the call.
How do you read the signaling here, then? Why isn't this a panic event?
First, analyze the transition plan itself. Tom Javage is not a mercenary outside hire brought in by a private equity board to just slash and burn. He has over 16 years of direct experience, specifically at Bath & Body Works, and 25 years with the broader L Brands parent company ecosystem. He was most recently the EVP of Brand Finance. He understands the internal plumbing, the vendor relationships, and the cost structure of this specific entity better than almost anyone. He represents extreme operational continuity.
So it's an internal handoff, not an external rescue operation.
Right. More importantly, look at the timeline of the financial guidance. If the internal revenue models were collapsing, if the consumer-first formula was failing to generate returns, the absolute last thing an outgoing CFO and a sitting CEO would do on a public call is reaffirm full-year guidance.
That's a great point.
If the math was truly broken behind the scenes, they would have used this executive transition as air cover to lower expectations, blame the macro environment for the miss, take a massive write-down, and clear the decks for the incoming CFO.
The classic kitchen sink quarter. You throw all the bad news out at once and blame the previous administration.
Yes. The fact that they stood their ground and told Wall Street, yes, Q2 will be ugly, but we are holding absolute firm to our full-year targets, strongly suggests that the underlying strategy and the financial models are stable.
Okay.
Eva Barato successfully built the financial foundation for this investment year. She secured the cash flow and allocated the CapEx. Now, the phase of the turnaround shifts from financial modeling to brutal day-to-day retail execution. The personnel is changing, but the math appears to be holding firm.
That is a very measured structural read of the executive transition. They didn't lower the bar on her way out the door. So we've gone to the talk ticker's ringer. We've crunched the Q1 macro headwinds and the petrochemical exposure.
We covered a lot of ground.
We really did. We've dissected the body care inventory failures and the Amazon metadata successes. We've looked at the painful Q2 forecasts, the off-mall real estate migration, and the C-suite shuffle. Now it is time to synthesize all of this data into a final verdict.
The bottom line, are we bullish or bearish on the structural health of Bath & Body Works?
If you are a listener holding this stock in your portfolio right now, or if you are sitting on the sidelines looking at the current valuation, factoring in all the macro noise and the internal renovations, what is the actual actionable move here?
Well, synthesizing the data, the strategy, and the macroeconomic realities, our opinionated talk ticker's verdict is that Bath & Body Works is a hold.
Okay. Oh.
Or, if you do not currently own it, it is a very patient, long-term speculative buy, but it is absolutely not a quick flip growth play for the next 6 months.
Walk us through the mechanics of the hold rating, because if Q2 is forecasted to drop up to 5%, why wouldn't an investor just sell now and try to buy back in later when it's cheaper?
You hold because the foundational logic of the turnaround is actually incredibly sound. Management is making the correct, difficult, long-term strategic moves.
Like the Amazon launch.
Exactly. The Amazon integration is a brilliant, low-risk customer acquisition engine that is demonstrably yielding higher average unit retail from an affluent demographic. The real estate strategy of closing dead enclosed mall stores and migrating to high-traffic, off-mall lifestyle centers is a necessary evolution that will yield higher operating margins. And culturally, the speed at which the executive team identified that everyday luxuries inventory mistake, spun up the supply chain, and rushed 10 fragrances back to market proves they are agile. They are not paralyzed by corporate bureaucracy.
They are awake at the wheel and reacting to live telemetry.
They are. However, the reason it is a hold rather than a screaming buy is because the immediate future is going to be incredibly turbulent.
Yeah, those headwinds.
You have massive, uncontrollable macro headwinds, crude oil, driving up the cost of plastic resin and paraffin wax, persistent tariffs, and sticky inflation compressing their gross margins. When you combine those heavy macro forces with the forecasted Q2 sales drop and the disruptive CapEx spend of redesigning 2,500 stores, you are guaranteeing near-term volatility in the stock price.
The analogy of the renovation is the perfect way to frame this. Management has explicitly labeled 2026 as an investment year. They are fundamentally ripping up the plumbing and the floorboards of the company.
Yes.
They are altering the supply chain, killing the treasure hunt merchandising, and shifting digital distribution. Management is essentially asking investors to sit in the living room and endure the deafening construction noise, the dust, the supply chain hiccups, and the compressed margins, with the promise that in 2027, they're going to hand you the keys to a beautifully optimized, highly profitable new house.
And that is the crux of the decision matrix for you as the listener. If you have a short-term time horizon, if you need this equity to appreciate significantly in the next 3 months, this is not the vehicle for you.
The construction noise of Q2 would just be too loud.
Exactly. But if you have a multi-year time horizon and you believe in the inherent long-term pricing power of this brand, which they absolutely proved, with the double-digit AUR jump on the elevated hand soaps, then you hold your position. You endure the volatility and wait for the house to be finished.
But we always want to give you a specific, actionable metric to track.
Yeah.
What is the canary in the coal mine for this specific turnaround thesis? What breaks the model?
Your actionable takeaway is to hyper-focus on the body care category metrics when the Q3 and Q4 numbers are released.
Why body care specifically?
Because CEO Daniel Heaf promised that bold innovation is coming to the body care assortment in the back half of the year to fix that mid-teens deficit we saw in Q1. That deficit must be erased by the holiday shopping season.
Right.
If they get through Q4 and body care is still dragging the aggregate top line down, the entire turnaround thesis fractures. It doesn't matter how beautiful the new store navigation is or how well the Amazon integration works if the core hero product category is still bleeding. Watch the body care volume like a hawk.
Incredible analysis. All right, let's quickly recap the 4 major talk tickers takeaways from this deep dive into Bath & Body Works. Number 1, it was a Q1 beat, but a mechanically complicated one. They hit 32 cents EPS, beating Wall Street's worst fears, even though top-line sales shrank 3.2% and structural petrochemical costs compressed their margins.
Right.
Number 2, the tale of two categories. Body care suffered a massive mid-teens drop due to the Disney accessory cannibalization and the everyday luxuries sexy rationalization error. But elevated products like White Bar Neutrals, the redesigned hand soaps, and the Amazon launch proved they still possess immense pricing power.
Which is key.
Number 3, the pain before the gain. Q2 is going to be a brutal quarter, with top-line sales forecasted down up to 5%. But management held absolute firm on their full-year guidance, signaling deep internal confidence in a massive back-half recovery. And number 4, it is a classic wait-and-see turnaround play. Our verdict is a hold. You must be willing to endure the heavy construction noise of this investment year if you believe in their long-term ability to migrate off-mall and elevate the brand perception.
Before we close out the analysis, I want to return to that unintended metadata consequence we discussed during the Amazon segment, because it leaves us with a deeply provocative thought about the future mechanics of retail.
Oh, the generative AI side effect.
Yes. Bath & Body Works noted that by meticulously enriching their product descriptions for the Amazon search algorithm-like, inputting highly structured data about top notes, mid notes, chemical ingredients, and functional benefits, they inadvertently optimized their entire catalog for generative AI engines like ChatGPT and Claude.
By trying to rank higher on Amazon, they accidentally taught artificial intelligence how to understand their fragrances.
It raises a wild existential question for the retail sector, especially for a sensory-driven brand. I mean, for decades, Bath & Body Works built its multi-billion-dollar empire on the physical mall experience.
Right.
The conversion relied on the physical act of a human being walking past a storefront, smelling warm vanilla sugar in the ambient air, experiencing an emotional memory trigger, walking in and executing a purchase.
Yeah, that invisible wall we talked about at the start.
But as digital commerce evolves past basic search and into conversational agentic AI commerce, how do you sell a scent to an algorithm?
I mean, you can't spray Japanese cherry blossom into an Anthropic server farm. The AI doesn't have an olfactory nerve or childhood nostalgia.
Exactly. So we have to ask, in 3 to 5 years, when millions of consumers are simply instructing their personal AI assistant, order me a high-quality, relaxing candle for my guest bathroom, will the success of a multi-billion-dollar fragrance brand be determined not by how it actually smells to a human in a physical store,
but by how perfectly its metadata appeals to the vector logic of an AI making the purchasing decision on behalf of the human?
Yes. Are we moving from an era of optimizing products for the human nose to an era of optimizing products for the large language model?
That is a staggering thought for the future of the industry. The invisible wall of atmospheric scent that defined the mall era might be entirely replaced by an invisible wall of perfectly structured metadata residing in the cloud. We will leave you to ponder the implications of that shift. Thank you for joining us on this deep dive into the Bath & Body Works Q1 results. Keep looking past the marketing fluff, keep digging into the raw data, and we will catch you next time.